Robert Z commented, understanding delta better. All right. And I want to take a look at this Fortinet position. It's a covered call. This is actually, again, a married put in the Fusion portfolio, opened on 226. Well, the married put was opened a long time ago, but when the stock was at 68.72, we sold the 8th of March 71 call for 76 cents. Stock closed at 71.35 today. Buyback price of the option is 44 cents. First, I want to take a look at the profit and loss chart. Yeah, there's my covered call. It's above my strike price just barely. This worked well for the married put because it was up at, as you can tell, 73 today. I didn't want to pay $2 to buy to close the call. I didn't want to pay $2.20 to buy to close the call. I didn't want to pay $1.30 yesterday to buy to close the call. It was only 80 cents in the money. They're charging me an extra 60 cents of time value for one day. I wanted to hesitate and wait. And if I was wrong and the stock moved up, hey, I'd pay more to roll this call because I want to stay in the position. Not related to your question, but it is important to sort of show that part of the illustration. Delta. When I originally opened this position, let's go ahead now. We're going to go to the call. And whether you're in the option chain, Robert, whether you're in the search tool, whether in your portfolio, when you want to analyze a call maybe a little bit more in depth, you can go to research and go to call research or option research. This shows you all of the current values, including the Greeks that we have for this particular option. And at the same time, we have a historical view of the position. And since we opened this trade back on 226, let me go back there, you can see that the option bid, the call price, I thought was the worst price for it, 76 cents. But it's gone up to $1.11, $1.35 option bid. The implied volatility spiked here because the stock fell. This was the perfect time maybe to buy back the call at 42 cents. And then it rose back up. I got out of this at 60 cents today, by the way, and rolled it to 2 weeks out to the 73 strike for $1.28. I think it was. Yeah, 60 cents and $1.28. In any case, with this historical graph of the data, what we can also look at is delta. All right. And what is delta, of course, Robert? Well, delta is the movement of an option, the expected movement of the option price based on a 1-point movement in the underlying position. For a call, you have a positive delta. So if the stock moves up 1 point and you have a delta of 0.5, which would be your at the money option. Show that in a moment. But if I have I'm at the money, my call, I bought a call right at the money with a 0.5 delta. If the stock moves up $1, I should expect to see a 50-cent gain in my option. In the covered call position that I'm in, though, what did I do? I didn't buy the call. I sold the call. So I actually had a negative delta when we started on the 26th. Oh, I got to be off the drawing here. I'm sorry. In that case, the delta was about 0.26. So as the stock moved up 1 point, I'm expecting the option to gain 26 cents at that time. But then what happens next? It's negative to me. I'd have to pay 26 cents higher to buy it back because I sold the call. So now I have a negative delta on my call. Even though the call has a positive delta, my action of selling it puts me negative. Now, let's take a different view here. Instead of the option bid, we'll come back to that. Let's look at the stock price versus the delta. We're uploading the historical data from today, Robert. That's why it's taking so long to come in, because this chart has to interact with all the historical data tables that are currently having a lot of data dumped into them for the close. But let's just take a look here. On 226, now I got 76 cents, but we're just going to use this at the close. The delta of my 73 call for today's expiration, March 8th, was 0.26, and the option bid was 61 cents. A day later, on the 27th, the option bid moved up $1.11. Okay, so why would that have moved up $1.11? It's probably because the stock, we gained 50 cents, so the stock probably moved up about 2 points. Each point, we gained a delta of 0.26. So That's what we want to look for, 226 to 227. What was the stock price change? Because we moved up from 61 cents to $1.11, roughly 50 cents, with a 0.26 delta. What else changed? The delta changed. Notice how it moved up, Robert, to 0.41. Delta is a static constant when you open the trade or when you're evaluating a trade to open. Delta is ever changing. As the stock moves up 1 point, the delta of the call is going to go higher. The delta of your put is going to go lower, but the put is negative delta. It's moving by what's called the gamma. So right now, at expiration, my delta of this call was 0.617. That updated. Oh, no, that was from yesterday. I think that was yesterday's close. And the gamma was at 0.3056. That means that if the stock moved up $1, I'd expect my call option to gain 60, 61, 62 cents. Oops, sorry about that. See if I can go back here. There we go. I'd expect the call, to move up 60, 62 cents or so. But after that dollar move, I'm expecting my delta to move from 0.6 to 0.9 by that 0.3056. Now, that's an odd thing to see because it's at expiration. And at expiration, what happens, Robert? If my call is in the money, it's going extremely quick to a delta of 1. And if my call is out of the money, it's going real quick to a delta of 0. That's why this gamma is so high, because we're at expiration. The 62-cent delta here, the day of expiration, if the stock moved up another point to 72.35, I'd expect that call option to go up another 60 cents to $1. That makes sense, right? Stock was at 72.35. My 71 call is 135 in the money. It's going to get closer to that 135 intrinsic value at expiration. But so as that first point, started to move, the delta would have moved up to closer to 0.9 by the movement of the gamma. And then it'd be pretty darn close, to 1, Robert, at that point. Now I'm going to try this again to see if I can further illustrate the example. Hopefully the history doesn't bog us down again. I want stock price versus delta, and we're going to stop it because I'm pretty sure it's not going to load up. That's perfectly fine. We're going to do it a different way. All right. So February 26th, stock closed, Fortinet closed at about 68.10. And on the 27th, it's at 70. What did I say? In order to see that bid price move from 60 cents to 111, when my delta was at 0.26, we probably saw a 2-point movement. So the delta gained that 26 cents and then maybe another 25 cents for a total of 51 cents plus the 61 cents it was, put me at $1.11 bid. But delta's ever changing. As this went up, the delta has to go up, so it moved up to 0.41. That was the 2-point movement, 68.10, 68.20 to roughly 70. Okay, maybe $1.90, Robert, maybe $1.80. But that was the change we saw in those 2 days. That is delta in action. It moved here with a 61-cent bid and a 0.26 delta when the stock was at 68.10, 68.20. To the next day, close at the 27th, it's up 50 cents to $1.11 because the stock moved up about $1.80 or $1.90, and now the delta's at 0.41 because the gamma had adjusted, or the gamma pushed the delta up. Someone always likes to, one of the other educators I talk to, he always likes to use the term, the gamma is the delta of your delta. It's how much your delta is going to move. So that's what delta is. And if you look at any option chain, I made that reference, of course, Robert, to the at the money option. But let's go to something that still has time left to expiration. Because why? Because pretty much everything here right now is a delta of 1, a delta of 0.6 because it's right at the money, or moving to a delta of 0. That's what happens at expiration. Let's go out to the 14th. And I didn't want to see that there, but that's okay. I'm going to hold this here. Let me just do something different. There we go. All right. Here we go. Robert, this is my delta column. These are just the calls we're looking at now. As you go in the money, what happens? The option is going closer to intrinsic value. It's moving closer and closer to your 1 delta. This is not a good position for a covered call because the closer you get to intrinsic value means you have no time premium, time value, which means you're not getting a return for a good covered call. You're getting a great downside protection. How far the stock can drop in a covered call before you're losing money on the position. It's not a viable return to be successful every 14 days. So, we start going a little bit less in the money. Delta of 0.85, delta of 0.78, 0.71, 0.63. Stock's at 71.35. Closest to at the money strike is 71 with a delta of 0.55. The at the money option at any expiration is going to be right around that delta. Let's go further down to the next expiration, 49 days out in April. The 71 strike, 0.562. The 72, 0.517, pretty close to it also, okay? And we talked a moment ago about income method number 4 in the put. It applies to all options. We referenced it in the married put structure about the at-the-money bell curve. This column here is the midpoint time value. And again, focusing on our closest to at-the-money option, the 71 strike on a stock trading at 71.35. This is for a call, but the put would be very similar. Delta of 0.555. In the calls, we go closer to 1 as we go deeper in the money, closer to 0 as we go further out of the money away from the stock price. But delta is ever changing. As the stock moves up 1 point, I'm expecting this option to gain 55 cents in value. Whether I bought it or whether I sold it, that's what my expectation is. But now my delta is going to move up from 0.55 to maybe say 0.638. Then it moves another dollar up to 73.50. My 71 probably has a delta of 0.717, and it's gained that 64 cents based on the new delta. It's ever changing. Implied volatility shifts suddenly in the market can cause the delta to shift as well. Now, going back to what I was just initially talking about, the at-the-money bell curve that you can see in any expiration on any stock. Oh, shoot. Let me just try that one more time, folks. I apologize. This is the midpoint time value column here. And no, I don't want to circle it, but what we want to show is here's our at-the-money 71 strike, and the time value portion of this 213 is 2.5%. As I go deeper in the money, the time value is going lower and lower. As I go deeper out of the money, the time value is going lower than lower. This is the at-the-money bell curve. This is where I want to be selling premium, essentially, to maximize the return in the married put structure. Possibly even in the covered call structure, but I get better downside protection by going deeper in the money. Even though there's a better kick here for the premium, there's better time value. Mike D's question coming up in a little bit as what is the, what are your favorite strategies? And he talked about what are the stops for credit spreads. I'm not saying you should ever do a credit spread at the money with only a 53% probability or a 0.55 delta. No, you're going to be over here, 88, 83% for bear call credits, bull put credits with that much lower delta out of the money. You're looking for the higher probability. You're out here, though, with the lower delta for a credit spread. But in any case, that's the at-the-money bell curve in action. Any strike price, any stock, any expiration date, the at-the-money options always has the highest time premium. Not related to the delta question, but it's always important. So, Robert, that's the gauge and view of delta. It's the expected movement, of course, of your option. I know you know the general definition. Based on a 1 point movement in the stock. Calls have a positive delta, puts have a negative delta. What I should have done, let's stay here. I apologize. Let's go to the 14-day out option. You can see the historical graph again, how it moved. This is more realistic, a much smaller gamma of 0.846. So what is this telling me, Robert, for the 71 strike, March 22nd? Yeah, March 22nd, my apologies, expiration 14 days away. If Fortinet moves up to 72.35 on Monday, I'd expect my option to move from 213 up to 268. because of the delta of 0.555 for the 1 point movement in the stock. I'm going to add 55 cents to that. If it drops $1, I'm expecting this option to go down to about, 168, right? Maybe 158. I apologize, 158. Okay, so if the stock drops down $1, I expect it to drop to 158. If it goes up $1, I'd expect my new price to be 268. Got a gamma of 0.085, which means if on Monday Fortinet moves up to 72.35, I'd expect my option to be priced at 268, and I'd expect my new delta on Monday to move up by this 0.85. So I'd expect it to be at delta of 0.64. Sorry, that's a terrible place to put the 6.4. There we go, 0.64. That would be my new delta. And then the gamma is also going to increase because now it's going slightly more in the money. So if it moves up another point, yeah, my option is going to go up to about 342. But now my delta is probably going to get closer to 0.7, 0.71 because my gamma was higher, maybe at 0.15, 0.16. It's ever changing. Now, if it pulls back down, my delta could go right back to 0.55 with a gamma of 0.846. Tuesday or Thursday of next week, the stock drops back to 71.35. I might see these same numbers for delta or gamma again. Robert, excuse me. That's what we might consider. It might be possible to see. But it's ever changing. It's changing based on the stock price, days remaining to expirations, and fluctuations in implied volatility as well. At the money options, you're always going to have that delta of around 0.5 to 0.55, 0.45 to 0.55. For calls, you go out of the money, the delta is going to be lower. Well, for both, it's going to be higher, calls and puts. And as you go in the money, it's always going to be higher. It's going to change for a 1 point movement in the stock price. The option premium by that expected value. It's not always 100% on point, but it's pretty close. But if there's a flux in implied volatility, that can affect the delta and the gamma and the movement of the option to move more or less than the 1 point expected movement related to the delta, depending on what is going on with the security. So, Robert, we do have some other education on that as well. If you go into the if you go into the webinars pages, we go into options concepts. I think there's a full discussion here on Greeks. I call it Greeks and why you may not need them. I don't even look at delta, gamma, theta, or vega for some of the option strategies I trade. But then there's ones I specifically pay attention to, the delta ratio and gamma. There it is, Greeks and why you may not need them. It's a very old one, but probably needs a rehash. But there's some other education there related to that. Diagonal calendar spreads, leap spreads. I look at the delta ratio, implied volatility ratio. Mary puts, I don't look at the delta too much. I'm more focused on the risk following the position. Bull put and bear call credit spreads. I use probability instead of delta for the range out of the money I want to go. And yes, I pay attention to the gamma a little bit in bull put credit spreads, but not a lot.